If you're investing in property in 2025 like it's still 2017, then you're probably making life harder than it needs to be. Rules have changed, timelines are slower, and some strategies that used to look great on paper can now be a real headache if you're juggling a day job as well. But the good news is that there are still approaches that work really well right now for new investors or anyone without a huge portfolio. And I'm going to show you two that I use myself and I still recommend them in my one-to-one sessions. The first one is a classic starting point, and the other has been a winner for me more recently, and I'm actually in the process of doing it again right now. It's that good. So let's start by setting the scene. The last few years haven't been especially kind to landlords. So first off, we've got Section 21, which is still being discussed right now, but it's likely to go into action later this year, maybe early next year. Section 21 used to let landlords regain possession quite easily with 2 months' notice, and it's being scrapped. So no more Section 21. It's instead being replaced with Section 8. Section 8 means that landlords can only take a property back if there's a legal reason, like rent arrears, antisocial behaviour, or selling the property. Now that's fine, I totally get it because it's right for the renters to have that protection, but it's more process driven, and the real issue is that the courts aren't quick, so it takes ages to go through. But aside from that, for quite a few years now, we've been suffering with Section 24 as well. So if you're a higher paying tax earner, that means that you're going to end up paying more tax. Section 24 basically means that landlords can no longer fully offset mortgage interest, which especially hits the higher rate taxpayers. And these two are just a couple of reasons why so many landlords are selling down right now. I think in early 2025, about 1 in 6 new listings were former rentals. That sounds like it could be bad news, but it's also an opportunity, because if you're a newer landlord and you want to keep things simple and lender friendly, you can pick up good properties where others are stepping out because they've been doing it for years. But I cover this in more detail in my wider market August 2025 update. I'll put a link up here. But we're here to talk about strategies that do work. So let's start forward with the straightforward single let. So take a standard 3-bedroom house in Newark maybe, or somewhere similar, and as a family rental you might see about £1,100 per month. Right now, this is October 2025, but in theory, after mortgage, insurance, maintenance and voids, you might spend about £800 a month on costs, leaving you about £300 net. As you can see, it's not life-changing money, but it is steady. It's easy to finance, it's easiest to sell, and it builds equity as values grow. So if markets do rise, you'll get that equity. Now, plenty of people think £300 a month isn't a lot. I want more cash flow. Maybe I should do something like an HMO, a house in multiple occupation instead. Let's look at that for a second. Now on paper, HMOs do look better. High yields from multiple rents under a single roof. So out of that larger 3-bedroom house, you might be able to squeeze 5 rooms if you convert the living room and the dining room. But in practice though, the compliance and workload jump up massively. So licensing, interlinked alarms, fire doors with closers, minimum room sizes, and if you're in an Article 4 area, you might need planning permission just to switch the use. And not only that, if you get any of that wrong, fines can run into the thousands of pounds. The local government really aren't forgiving. Let me do a little diagram here just to show what I'm talking about, because I see HMOs at the far end of the cash flow spectrum. So for a single property, if you decide you want to go with a single let, your cash flow may be lower, but your stress and effort level are low as well. So this would just be a single let. Whereas on the other hand, an HMO is high cash flow, but high stress and effort. Again, because of the licensing, because of the management of the property, because of the voids, it is stress and effort. Now what you would think is that most other strategies would fall somewhere in between here, right? Depending on the effort you put in and the stress that you're having to deal with leads to a change in the cash flow. But I actually think there's an outlier strategy on this chart, and it's the one that I'm going to recommend as my second one. Now what this is higher cash flow, admittedly not as high as HMO, but far less stress. So you can see here it's actually an outlier because you get more cash flow but it's less stress. And this strategy is the Group AST house share. So imagine if you did own that 3-bedroom large house. Instead of converting it to an HMO where you convert both the living room and the dining room, a Group AST house share, AST standing for Assured Short-Hold Tenancy, which is a regular tenancy agreement, means that if local rules allow it, you have the same house with a different setup. So you could either go for 3 individually let bedrooms as part of that house, or just convert the living room or the dining room. So instead of one single let giving you £1,100, you only convert one of those rooms, maybe the dining room, to a bedroom. You then advertise the whole house as a 4-bed house share and set up a meetup so the group can buddy up. Once it's then rented for that first time, ideally to a group of young professionals who all know each other, which is what I tend to target, you've then got 4 sharers, possibly each paying around £500 a month. So that's £2,000 of rent. So your costs will be a little bit higher than the single lets. So where a single let, say, had that £800 of costs, The group house share might be around 1,100 to 1,200, usually because you have the bills included as well. You could be looking at £800 to £900 net, which is easily more than double what the single let gave you, possibly even triple. And just to clarify, I'm not pulling these numbers out of thin air. They're actually pretty close to one that I've got going on right now. I've just rounded them to the nearest £100. So you might ask, isn't this an HMO? Well, yes and no. As far as a house class is concerned, yes, it's technically a small HMO, so you need to convert a property that's a C3 to a C4 class, which is actually permitted development if you're not in an Article 4 area. But when it comes to the licensing and financing side of things, it's not treated the same way as a large HMO, and this is exactly why it's such a great option. You get the excellent cash flow. It's not quite as good as a full-blown HMO because you're only 4-bed rather than 5-bed, but you don't have the faff of the license, the HMO-specific finance products, and then all the rules and the regulations like those fire doors, smoke alarms, inspections, and scary fines. But the best bit of all, in my opinion at least, is that you're still valuing it as a residential property, not a commercial, like a lot of HMOs are. So you've got mainstream finance and no valuation headaches. It's also finance friendly, as I mentioned, so most lenders are fine with up to 4 tenants on a single AST. You've also got the option of an easy exit, so if you need to, you can revert it to a single let, so you just change the dining room back into a dining room. So you have no loss of value really there on the property itself. If you were converting an HMO back to a standard residential, it's pretty intensive and costly. So not many people tend to do it, and they try to sell the property as an existing HMO. And if you just look at the market right now, then you'll see so many HMOs are out there and not shifting. And also you've got tenant stability too. So the group that tends to share the property often already knows each other, and if someone moves out, they usually help find a replacement. And then finally, you have less stress and a more positive headspace. You avoid all the mandatory licensing and then all the fire door circus of large HMOs. So in the property I've just purchased, where I'm planning to do this, I definitely could force a 5th bedroom out of this property, but then that would tip it into the mandatory licensing for HMOs for just that bit of extra rent. And for me, personally, it's not worth the extra stress. So I prefer to do this strategy in the middle between single lets and HMOs, where I'm getting multiple occupants in without all the licensing faff. And my sister actually lives in one of these setups in Chester. She started with friends, and then people moved on, but the group handles viewings themselves, and then they keep the vibe right because they want to live with that person. So then the landlord just approves, references, and then updates the deposit, which is super simple. And most of the time, for these agreements that you have, you'll have a clause in there that lets the tenant leave early if they find a replacement, which massively reduces the voids, because it means that they're seeking someone for you to replace them when they leave. So you have a consistent flow of rent. Now you probably will have finance and contract rules around this, and you can look into that yourself because I don't want to get anything wrong in this video, but you might have to have a head tenant as part of the contract, who is the one that maybe collects the rent from everyone else and then pays you. But there are different setups, and it's worth maybe speaking to a mortgage advisor who can advise you further. But additionally, a quick note on Article 4. So outside of Article 4 areas, Newark and Sherwood is one of them, the conversion from C3 to C4 class of a property, like this would require, is usually a permitted change. So no planning application is required in most cases. As long as you keep it to 4 sharers, then you avoid the mandatory HMO licensing. Still, remember to double check the street for the property you're buying before you put an offer in. But although this strategy does sound amazing, there are 3 things that you need to check to make sure that this will work. The first is licensing. So some councils require additional licensing for 3 to 4 individual sharers. So this strategy won't work there. The second is planning. So in Article 4 areas, you'll need permission to switch from C3 to C4. And the third is tenancy mechanics. So make sure your AST, your assured short hold tenancy, is set up to allow the smooth change of sharer consent, referencing, right to rent, and deposit updates. So let's round this video off with a quick recap. A single let is the steady financeable base to begin with, and it's what I recommend to start. A big HMO can work, but it's complex and high stress. And then the group AST house share is the balance. So you've got stronger cash flow, easy finance, tenant stability, and the flexibility to exit the property and sell it quickly if you need to. Now, I'm not saying that other strategies around these don't work. So flips, serviced accommodation, large HMOs, they all have their place. But if you do want sanity and solid results in 2025, this is where I'd focus. Simple single lets and group AST house shares. I actually talk about this quite a lot in my consulting sessions. It's about finding strategies that fit your life, not the ones that break you down. because I firmly believe that enjoying the process and having positive mental health is the real key to long-term success in property. So if you're new to property and you've got £20,000 to invest, I'll put a video over here on how I'd get started in property if I were beginning again with that much money. And if you want more practical breakdowns from me, please hit subscribe. I also have free property resources on my website too, and I'll put a link in the description below.